as it would help you to trade with better conviction and accuracy. Now, there are three things to look out for within a fair value gap. The first being the start of the fair value gap, the second being the consequent encroachment or the 50% of the fair value gap, and lastly, where the price completely fills the fair value gap. You can make use of the Fibonacci tool to mark these levels within these fair value gaps. When the price returns to the fair value gap, we should look for a few different things. This will give us a better idea if the fair value gap is respected by the price or should it be considered invalid. I will be considering a bearish fair value gap or a CB for this purpose. So first, the price can either reach up into the fair value gap but close outside the fair value gap and continue lower. Price can also reach up into the consequent encroachment or 50% of this fair value gap. In this case, we would like to see the candle close outside the fair value gap, but as long as the price is respecting the consequent encroachment, we can be pretty flexible with the price closing just below the consequent encroachment. Sometimes the price can also reach up to fill the fair value gap, and in such cases, it is preferable to see the price closing outside the consequent encroachment of this fair value gap. The most important thing to look for when invalidating a fair value gap is where the price closes. So when the price starts to close over the consequent encroachment or outside of the fair value gap, it is an indication that the price is not respecting the fair value gap, and most of the time, price will not reverse back down and the CB is deemed invalid. Now let's look at a few examples to understand this concept better. So we have a CB right here. Let's mark out the consequent encroachment using Fibonacci tool and see what happens. So you can see when price reaches up into this fair value gap, does not close over the consequent encroachment, or in other words, price respects the fair value gap and it is still valid for a reversal to happen. Now let's take a look at another CB right here. Let's mark out the consequent encroachment. You can see that the price did not respect the CB at all and closed right through it. This is when we will invalidate a fair value gap because the price is not respecting it. Now, if you look at a busy or a bullish fair value gap right here and mark out the consequent encroachment to see what happens. The price reaches into the fair value gap and closes out. So it is currently respecting the busy and it is still deemed valid. Another case is when the price breaks out and closes below the busy, and in that case we can confirm that the price is not respecting the busy and it can be regarded as invalid. The next thing we are going to look at is fair value gap inversion. To explain this in simple terms, inversion happens when a fair value gap fails or when the price closes through it, and then this fair value gap can be used as a support or resistance for future price movements. What this means is that I would expect price to return back to this old CB to use it as support and move away. Similarly, price could return back to an old BC to use it as a resistance and then move lower. Another thing to note is that this does not have to happen back to back, meaning that this can occur later on after a period of consolidation. Let's look at some example to clear things up. So we have a CB right here and the price closes through it. So it is considered invalid. But that does not make it useless. We can then look to see if the CB supports the price. And we can clearly see that this old CB acted as a support for prices before getting a move higher. Here's an example of what I mean when I say that the fair value gap inversion does not need to occur back to back. So we have considered another BC, and right here we get a close below this fair value gap. So it is deemed invalid. Now let's see what happens when price returns to this old BC. You can see that the price returns to this old BC. It uses it as resistance to go lower. But this did not happen suddenly, and the price took a while to return back to this BC. For our next example, we have a CB right here. So let's see how the price reacts to it. And you can see the price has filled this fair value gap, but the price closes out of it. So it is currently respecting this CB. But right after this, we can see that the price closes over this CB, invalidating it. Now let's see if an inversion happens when the price returns. And you can clearly see how the CB was used as support and the price returned. So I think that clears a lot of questions regarding imbalances or fair value gaps. You need to be aware that imbalances in chart create the fuel for the uptrending price movement. However, you should not mindlessly enter a trade in an imbalance zone. It is necessary that you use strong confluences and it is also necessary to monitor the context and make decisions based on it. In this video, we will discuss the most important concept in the whole smart money concept approach. Or maybe it is one of the keystone topics when it comes to trading as a whole. It is none other than liquidity. We retail traders like to get things done the easier way. Therefore, we usually focus on indicator signals for taking trades. We are least bothered about why the price moved in a particular manner that triggered the indicator to give a buy or a sell signal. Almost all indicators are derived from fundamental elements of the market, which are price and volume. Further, price and volumes are a result of the post-processing of basic market data. So the point that I want to elaborate is that indicators can to some extent do a good job in generating winning trades. But most indicators fail to work in all market conditions, and the signal provided by a single indicator cannot be trusted completely. And to top it all off, almost all indicators are lagging in nature, and they give a trade signal after the move has already started, which result in more risk and thereby lowers your reward to risk ratio. So one way to stay on top of the market is to play the game like the market makers, big institutions or banks, or simply the smart money who feeds on the retailer orders to make a living. The big price moves or momentum moves that you witness in the market are a result of the smart money trapping the uninformed traders, or should I say the ill-informed traders, because retail education, as we all know, is based on patterns like candlestick patterns, chart patterns, trend lines, support resistance zones, etc. And eventually they hope on to taking trades on the signals given by conventional indicators or price patterns. I'm not saying that these patterns and indicators don't work at all, but there are high chances that most of these can be engineered by the big players. These big institutions or smart money are always trying to trap us and take our stop losses. So when new traders come fresh onto the markets, they can easily be manipulated and money can be taken away from them because they are easy prey for the big boys. The retail traders' lack of knowledge as to where the majority of market orders are accumulated makes them vulnerable to these institutional traps. This is the major reason why most of the retailers lose money. They remain as prey to these banks and institutions, or in other words, they are liquidity for the big players. In essence, this is a cat and mouse game. In order for one person to win, someone else needs to take a loss. So the question is, what do you want to be, the cat or the mouse? Now there is a popular saying in the market that if you don't know where the liquidity is, then you are the liquidity. So in this episode and the upcoming episode, we will talk extensively about this prime concept of liquidity to stay ahead of the majority of retailers and also to stay clear of most of the smart money traps. I can guarantee you that once you understand the entire concept of liquidity, you will think more clearly as to how the market functions, and it will also open up new trading possibilities for you. So let's get started right away. For some of you, there might still be this doubt as to what exactly is meant by liquidity. So in simple terms, a market with high liquidity is one where there is a large number of buyers and sellers willing to trade in that particular asset. This means that there is a high availability of buy and sell orders, allowing transactions to be executed quickly and with minimal impact on prices. So think of liquidity as an area where there is stop losses and pending orders waiting to be filled. We can find liquidity in areas or zones where many people place their stop losses, be it buy or sell stops. Usually, retail traders are impulsive and they tend to buy at highs when greed kicks in and they sell at lows when panic kicks in. But at all times, when there is a buyer in the market, there is always a seller and vice versa. And that's how the markets work. Now, the smart money, aka institutions, use this retailer liquidity, that is the orders of the retail traders against them. For example, the institution buys at lows when retail traders sell after a breakout of that low. Similarly, they sell at highs when the retail traders buy after the breakout of a high. So, in essence, we are all liquidity in the market. However, that does not mean every single order which is being placed in the market must be targeted and taken out by these big players. as some areas are simply not liquid enough for it to be worth the grab for these institutions. So in short, liquidity is like fuel, or it acts as a driver to move the market in a specific price zone. Smart money will try to manipulate the price in order to break through these obvious zones and seize or absorb the liquidity. To sum it all up, every market has retail traders and institutions. The retail mindset is almost same across all the markets, and liquidity in smart money concepts enable us to understand where these retail traders are being manipulated and where the smart money is entering or exiting. Now, another question can pop up in your mind. Where to find these liquidity zones or order clusters? Now, there are two types of liquidity based on direction. They are buy-side liquidity and sell-side liquidity. The buy-side liquidity represents a level on the chart where the short sellers will have their stop loss positioned. So essentially, these stop loss orders set by the short sellers who sold from the resistance or the swing highs are essentially buy orders. And the buy-side liquidity will also include buy limit orders set by all those buyers who were waiting for a breakout above the resistance or the swing high. When it comes to sell-side liquidity, it is just the opposite. It represents a level on the chart where long bias traders will place their stop losses. So essentially, this cluster of orders will include stop loss orders set by buyers who went long from the support level or swing low level, which in turn is a sell order. And sell-side liquidity will also include sell limit orders which were set by those sellers who were anticipating a breakdown below the support or swing low. In both these cases, these levels are often found at or near extremes as the tops and bottoms of the ranges, meaning that these points are found at the highs and lows of ranges. This is because at these points, many people are waiting for the zone to act as a support or resistance, or for the price to break the zone to continue in its direction. So you can always use higher time frames like daily, weekly, and monthly time frames to identify these zones. Now, if you want to understand where to find liquidity even simply, then understand that whenever there is a trend line, support or resistance level, double top or double bottom patterns, channel patterns, rectangular ranges, swing levels, etc., there are a lot of retail stop losses and pending orders available, meaning that there is enough liquidity to be taken. Therefore, these are popular areas where retail traders tend to execute their trades. So there will be a lot of stop losses, making it a nice level of liquidity for the big players to target. But before all that, let us understand why liquidity is important on a price chart. So if you think about it, liquidity is extremely important because it is the direction in which the price moves. The price will always move towards these points to attract liquidity to the market. Without liquidity, financial markets cannot function. Let me explain this so that you will have a better idea. See, big players in the markets aim for the best prices, but usually they face challenges finding sufficient counter orders to fill their large orders. For example, if an institution is looking for long positions, they will place buy orders at limit prices. But for the order to get executed, there needs to be enough sell orders, right? Now think about what happens if they enter the market at low liquidity areas where there are only fewer orders available to counter the institutional orders. This will create much more volatile markets, which will negatively impact the average price of the big players, which is actually a risk they are not willing to take. Now, on the contrary, entering at a high liquidity area where there are a lot of counter orders available will result in less volatile markets, ensuring a better average price for the institutional position. And these high liquidity zones are where most of the retail orders are placed. Smart money players understand the nature of this concept, and they will commonly accumulate or distribute their large positions near levels where many stop losses resides. This concept of absorbing retail orders by taking advantage of all available liquidity at multiple price levels is called as liquidity grab or liquidity sweep, and it comes from the need for big players to enter the market in these zones to take their large positions, and it ensures that their orders are filled at the best possible prices by breaking up their order into smaller sub-orders and then spreading them across multiple price levels. So institutional traders and high-frequency trading firms commonly use liquidity sweeps for efficient and quick execution of large trade volumes. And the sheer amount of stop-loss orders available at these key levels allows a large player to fully realize their positions. And once this level where many stop losses have been placed has been traded through, it is often seen that the price will reverse its direction and head in the opposite direction, seeking liquidity at the opposite extreme. Now, think about the result when a large number of stop losses are triggered. If price experience higher volatility or more orders hitting the market, such volatility in price generates opportunities for participants to either enter a trade in a favorable environment or protect their positions. The fact that too many orders were triggered all at once result in sharp price moves in the market. So without ample liquidity to play with, we will never see such big directional moves in the market. In fact, how will a car be able to move without fuel? Similarly, it is liquidity zones and liquidity sweeps that helps to run the markets smoothly. Now, I hope this clears things up. Next up, let's briefly touch upon the different types of liquidity areas within the market structure. Based on this, liquidity can be classified into external liquidity and internal liquidity. Now, as the name suggests, liquidity associated with major market structure is referred to as the external liquidity. It is also known as major liquidity, and the liquidity associated with minor or internal structures in the market is named as internal liquidity or minor liquidity. In this video, however, I will only talk about external liquidity and how to spot external liquidity. So to understand what external liquidity is, we need to have a fair understanding about market structure, predominantly the major market structure. I have already made a video on market structures and how to properly mark the swing points, namely the swing highs and lows, and also to identify and mark break of structure, change of character, etc. So if you haven't watched the video, I urge you to pause this video right away and watch the first episode of this course right now to get a better understanding as to how major liquidity functions. To briefly summarize things, a bullish market structure will have higher swing highs and higher swing lows. A higher high is confirmed only after a valid pullback, and a higher swing low is confirmed only after a valid break of structure. And a change of character happens when the price break and close below the previous swing high or higher high, thereby shifting the market sentiment towards bearishness. Now, when it comes to a bearish market structure, it comprises of lower swing highs and lower swing lows. A lower high is only confirmed after a break of structure, and a lower low is confirmed only after a valid pullback. And a bullish change of character happens when price manages to break and close above the previous swing high or lower high, indicating a shift in the sentiment from bearish to bullish. Now, these are basically the things that you need to keep in mind while learning the major market structures. Now, let me ask you, which are the most important points when it comes to major structure? Quite clearly, these points are higher highs and lows and lower highs and lower lows, or simply these are the major swing highs and major swing lows. Now let me ask you another question. Why do you think the market does a break of structure or a change of character and then does a pullback? What do you think about this particular behavior of the market? Okay, let me explain. Let's take the case of a bullish break of structure and a bearish change of character. Now, what are they? These are basically simple breakouts, right? But if you think about it on a much deeper level, what exactly is taking place here? As we are aware, a bullish break of structure happens when price breaks and closes above the previous swing high or higher high. So one must focus on the swing high level. The swing high is considered as a strong resistance level or a supply zone. There can be at least two types of participants waiting in this area. The former would be sellers, who are obviously trying to take short trades from the swing high or the so-called potential resistance level. And where will they put their stop losses? Quite obviously, they will set their stop losses, which is actually a buyback order above the swing high. Now, the second group involves buyers who are anticipating a breakout of prices above the swing high level because the current market trend is bullish. So, what will these buyers do? They will look to buy on the breakout and they will place their stop loss, which is a sell order, just somewhere below the swing high level. So as you can see, there is a large cluster of orders available above and below the swing high level. So this is a highly liquid area. So now what will happen? Depending on which side has majority of orders, the market will move in that direction to absorb or sweep the liquidity. In this case, a breakout above the swing high has happened, meaning that the concentration of buy order was much more than the amount of sell orders available below this level. This is why the market moved higher, absorbing all the seller stop losses and buy limit orders. A similar scenario takes place in case of a bearish change of character. Which is our level of interest in this case? Yes, you are right. It is the higher low or simply the swing low level. Now, applying the same logic here also, there are at least two interested players here. The former are buyers, since the swing low has the potential to act as a support or demand level, and since the trend is also bullish, the buyers will look to take long trades from this level. And where do you think they will set their stop losses? Quite obviously, they will set their stop losses, which mind you is actually a sell order, somewhere below the swing low level. Now the second group comprises of those sellers who are looking for a breakout below this swing low level. Now if you look carefully, you can see a proper trend line, and thus they will bet on the breakdown below the trend line as the price has tested the trend line multiple times. So they will look to sell on the breakdown, and they will obviously place their stop loss somewhere above the swing low or even above the recent swing high. So quite clearly, there are a large number of orders available above and below the swing low level. So this is a highly liquid area. Now what will happen? Depending on which side has majority of orders, the market will move in that particular direction to absorb or sweep the liquidity. In this case, a breakdown below the swing low has happened, meaning that the concentration of sell orders was much more than the amount of buy orders available above this level. This is why the market moved lower, absorbing all the buy stop losses and sell limit orders. I hope you have understood. In a similar manner, you can understand what happens during a bearish break of structure or a bullish change of character. Now, I hope things are making sense. But still, a question remains. Why don't the market just keep going in the direction of the breakout? Why do price stop and return back? Or why do prices form pullbacks? So if you have observed closely, once the price does a break of structure or a change of character, it does not move up or move down indefinitely. If we take the case of a bullish break of structure above this previous swing high, we will come to know that the price will move up only to that extent where the orders are available. Or in other words, as long as liquidity is available above the swing high, the market will move higher. This is because the smart money is absorbing all the buy side liquidity so as to sell high. And once it has absorbed all the orders above this swing high, where do you think the market will go? Now, one thing that you must keep in mind is that the market moves from one area of liquidity to the other. So based on this idea, where will the market find liquidity once it has swept all the orders above the previous swing high, or once the buy side liquidity is completely taken out? Think about it. There is no liquidity available anywhere higher. So no point in going higher. So where will the market go now? This is where we have to think about why the market does pullbacks after a break of structure or even a change of character. I can just tell you that it is the inherent nature of the market to move as waves, forming impulse and corrective moves, and just stop the discussion. But understanding the reason behind these pullbacks are very important. Let me remind you that the market needs fuel to move higher or lower. This fuel is none other than liquidity in the form of retailer buy or sell orders, as you may already know. Now, liquidity is the reason why market forms impulses and corrections. In this case, after sweeping out the buy limit orders and buy stops, which is actually the buy side liquidity, the market pullbacks lower. And what is the purpose of this pullback? The pullback is the way in which the market is looking for a sell side liquidity. And where can we find these clusters of sell limit orders and sell stops? This is why you need to have a proper understanding of how the market structure forms and functions. In this particular case, after a bullish break of structure, the market can pull back to a few possible levels where it could find liquidity. And only after it has tapped the liquidity from these levels, the market will continue to move higher. These levels could either be internal or minor swings formed within a wave, or it could be the major swing low also. Below these minor swings and major swing low levels, there will be a lot of players looking for a trade opportunity. Usually, the previous major swing low level is considered to be a strong demand zone or a support level. So most buyers would be interested to take a long trade from this level, and they will obviously set their stop losses below this major swing low level. So there will be a lot of sell orders available below this level, and so the market could tap into this liquidity pool to sweep all the retailer stop losses to buy at lower prices and then move up higher. Now the price won't always move all the way down to this major swing low. If you look at the chart, on most occasions, the price will pull back only by 40% or 50% before resuming the main trend. Now what do you think is the main reason for this? Now, I want you to understand that when price pulls back, it has got a few liquidity options to tap into. I have not discussed some of these terms yet, but bear with me on this. So the first option is to tap into an inducement level, which you can consider as a previous minor swing below which you can find liquidity, as traders will look to buy from this level assuming a double top formation, while some sellers will place sell limit orders anticipating a breakdown of prices. Now both this action will result in a pool of sell-side liquidity that the smart money can tap into. The next available options are order blocks or point of interest, and just for the sake of understanding, assume POI as areas where large number of buy or sell orders are placed by institutions for the sake of buying low and selling high, and we can expect the market to reverse from these zones. So the market can tap into either of the two order blocks. The first is a decisional POI, which is usually formed after an inducement, and there is a 50% chance that the market will tap into this liquidity area and reverse higher. And the other order block is formed near the major swing low level, and it is usually called the extreme POI. So the other 50% chance is that this extreme POI will be tapped to absorb orders. The price will go deeper into these levels to absorb all the available orders. Usually, we SMC traders will take buy and sell trades from any of these three mentioned liquidity levels. We will talk about the concepts of inducements, order blocks, POI, etc. in our upcoming episodes. But I hope you have understood the overall concept behind external liquidity. Now let us briefly take a look at where to spot these external liquidity levels, or under which circumstances can we observe these levels. So as you may have already guessed, the major swing highs and major swing lows, especially on higher time frames, are high probability areas where we can find major liquidity. You can understand this using a simple example. You can mark the structure on a 1 minute time frame, which is a lower time frame, and then mark the structure on a 1 hour higher time frame. In which time frame do you think there will be more orders present near the swing highs and lows? Without much thinking, we can say that the higher time frame swing levels will have more liquidity in comparison to the 1 minute swing levels, meaning that there will be more meaningful price reactions on higher time frame structures. Another location to find major liquidity is where equal highs or equal lows are formed near the previous swing highs or swing lows respectively on a higher time frame. There are good chances of finding sell-side liquidity below these equal lows and buy-side liquidity above these equal highs. The same logic applies to double tops and double bottoms, which are formed near these major swing points. Yet another location where you can find major liquidity is below an uptrend line drawn connecting the major swing lows, or above a downtrend line drawn connecting major swing lows. These trend lines are quite lucrative places because you can find both buy and sell side liquidity, because one party is looking to benefit from a breakout of the trend line while the other party is looking to gain from a reversal from the trend line. Obviously, the smart money will target these trend lines, and most often you can see fake outs from these trend lines, which are none other than the big players sweeping the liquidity to get better entry prices. Now, the other important locations where you can spot major liquidity includes the previous monthly highs and lows, previous yearly highs and lows, previous weekly highs and lows, and even the previous daily highs and lows. These are all levels that a large number of participants are keenly watching to take a trade, and therefore there will be a large number of orders getting accumulated here. These are all prospective locations with very high liquidity. Since we don't have the kind of information that the big players possesses, we cannot determine the strength of a liquidity area and the exact location of liquidity at all times. Therefore, we can only predict where the liquidity can be discovered. But you must understand that the larger the time frame, the greater the liquidity. However, the more we go down onto smaller time frames, the more weak the liquidity will be. So these are all the things that you need to know about liquidity, especially external liquidity. In the next episode, we will turn our attention to internal liquidity.
Are you one of those traders who gets into a trade near a level of importance or beat a peculiar chart formation, but the price goes against your trade, takes out your stop loss, and the next thing you see, the price reverses its direction and moves in the same direction as you have anticipated in the beginning? I have been there, and it's very frustrating. And if you are one of them, then this video is for you. This video will definitely change the outlook of how you look at the charts. In the previous episode, we have talked in detail about liquidity, its importance, and we have also discussed in detail as to how major liquidity functions and where to find them. So, if you haven't watched that video, please make sure to watch it right away because it will give you all the basic stuff that you need to know when it comes to the concept of liquidity. But just to brush things up, liquidity is generally known as the fuel in the market, which is usually a cluster of retailer orders. That is, it can be limit orders and stop loss orders, which, when taken out or swept, causes the market to usually reverse in the direction of the existing market trend with a strong momentum. This will usually result in a fake breakout of the previous high or the previous low, which can be in the form of deep wicks taking out retailer orders. This is called as liquidity grab or liquidity sweep. Now, market always moves from one area of liquidity to another. So when liquidity is taken, the market needs to generate liquidity in order to move, which means if liquidity isn't already there, it will be created. And we have also talked about buy side and sell side liquidity. Then we have discussed about major or external liquidity, which in short is the liquidity available at or near the major market structure, which includes the major swing highs and major swing lows. You will get a good idea on market structures if you watch my video on the same topic on episode 1 of this course. In addition to this, major liquidity can also be found at or near higher time frame supports and resistances, weekly or daily highs and lows, etc. Now, in the previous episode on liquidity, I have classified liquidity based on market structure as internal and external liquidity. But looking at a much broader perspective, we can categorize liquidity into four types, of which the later two of them are actually applicable to the previous two classifications. I will explain this right now. But first of all, the different types of liquidity classifications are external liquidity, internal liquidity, static liquidity, and dynamic liquidity. As mentioned just now, external liquidity is the liquidity that can be identified above a range high or a range low, previous high or a previous low, or swing high or swing low. Internal liquidity, on the other hand, is the liquidity created within a range high and range low, previous high and previous low, or a swing high or a swing low. Now, when it comes to static liquidity, this liquidity is created or it is identified at or near double bottoms or double tops, or simply near equal highs or equal lows. And finally, dynamic liquidity is actually identified as the liquidity which is associated with a trend line. So, this liquidity is created at both sides of a trend, that is, above and below a trend line. Now, you might have understood how the last two types of liquidity, namely the static and dynamic liquidity, are related to the first two types. It is simply the fact that trendline liquidity and liquidity associated with equal highs or lows, or simply the double tops and double bottoms, are observable in both major and minor structures in the market. Now, we will understand about internal liquidity, how to read it or how to spot it, and how retail people get trapped in these areas. As you may know, minor liquidity is the liquidity associated with the internal market structures. This means all the clusters of retail orders which are getting accumulated between the major market levels, like the major swing highs or the major swing lows, are known as internal liquidity. So you can anticipate a lot of retail stop losses and limit orders at or near these minor swing structures. In the screen, you can see a few structures. These are all common areas where you can spot internal liquidity. We will first understand each one of them and then take a few examples from real charts. This is not a very difficult topic to understand. All you need to do is to think how a retail trader will respond when provided with a particular situation in charts. So, all you have to do is to think like you always have as a retailer, and without much efforts, you will be able to identify where the minor liquidity is already available. In the first diagram, we can easily spot equal lows. So technically, we have two lows on the same price level, thereby forming a minor support level. It is also known as double bottoms. We have learned that double bottoms are reversal patterns, right? So what do you think a retail trader will do when he or she spots a double bottom pattern? It is very obvious that they will try to take a long trade either after a breakout above the neckline, or some might even take a long position from the support level connecting the lows. Now comes the important question: where will they set their stop losses? Almost all of them will place their stop losses somewhere below the support level. Now you can imagine that there will be a large cluster of stop loss orders lying below this support level. These are all stop loss orders set by the buyers who have taken a long position, and these stop losses are sell orders or sell side liquidity. But what exactly do you think this is? This, my friend, is retail liquidity that we have been searching for. Now, what happens next? Or what will be the outcome? The smart money will always look to buy at lower prices, and they will look to sell at higher valuations. They do not follow any strategy or patterns, but they take their positions based on liquidity. So, most often or not, they will look to tap into these areas of liquidity to execute their positions at the best possible valuations. Now, coming back to a discussion on double bottoms, the smart money or institutions will push the prices down and break below the equal lows or support level so as to absorb all the sell side liquidity. And once all the stop losses are absorbed or swept, the market usually reverses its direction and move higher. This is usually more frustrating for traders than hitting the stop losses, because usually such a move will impact a trader's psychology, and it will also question his analysis and learnings. So, in short, there is liquidity below equal lows or below the support level connecting the lows of the double bottom, which is actually a cluster of sell stop loss orders or sell side liquidity which gets tapped by the big institutions to buy at lower valuations. Now, the second diagram shows equal highs. It means that we have two high points on the same price level. This is also known as a double top pattern. Like a double bottom, this is also a common reversal pattern that you can find on charts. If you have clearly understood how liquidity and retailer mindsets works in case of a double bottom, then understanding the logic behind double tops or equal highs is just a piece of cake. Ask yourselves, what will a retailer do when they spot a double top pattern? They will try to take a short trade either after a breakdown below the neckline, or they might even sell when the price starts falling from the top resistance level connecting both the tops. Now, where will they set their stop losses? Most commonly, retailers will place their stop losses somewhere above the top resistance level. Now you can imagine that there will be a large cluster of stop losses lying above this resistance, and almost all these stop losses are placed by short sellers who sold from the resistance or neckline. So technically, this cluster of stop losses are buyback orders or buy side liquidity, and this is the liquidity that smart money is keen to tap into. So, what do you think will happen next? Smart money will always look to sell at higher valuations, and they will try to collect the retailer buy stop loss orders or the buy side liquidity which is clustered above the double top or the top resistance level. So, most often they will push the prices higher and break above the equal highs or resistance so as to absorb all the retail orders to sell their positions at the best possible prices. And once all the stop losses are grabbed or swept, the market will usually reverse its direction and move lower, which can be really heartbreaking. Now, if you have understood both these types of liquidity, then the next few types are going to be really easy. Yes, we are talking about support and resistance liquidity next. So, what happens in a support level? Think about it in terms of a retailer. What will be a retail participant's thought process? So, when price test a support level few times, we can anticipate two types of market participants around this area. The first group involves buyers who are looking to take a long position at or above the support level to take a reversal trade. The second group are sellers who are looking to profit from a breakdown below the support level. Now, how will both of these players act in this scenario? First up are the buyers. They are looking to take a long trade entry, so they will try to buy at or above the support level, and they will place either buy limit orders or market orders. Now comes the important question: where will they place their stop loss? They will set their stop loss somewhere below this support level, which is actually a sell order. And when it comes to short sellers, they are looking for a breakdown below the support level. So they will either place a sell limit order or a sell market order at or below the support level when the breakout happens. And these guys will set their stop loss somewhere above the support level, which is actually a buyback order. Now, as you can visualize, there are a large clusters of buy and sell orders getting accumulated above and below the support level. Or in other words, there is sell side liquidity or clusters of sell orders below the support, and buy side liquidity or clusters of buy orders above the support level. And this is a golden opportunity for the smart traders to capitalize on. So, what do you think will their action plan be? You might have seen and experienced this happening many times in the chart. The smart money will first push the price below the support level to break into the sell side liquidity so as to be able to execute their large buy order positions at the lowest price possible. This will result in retailer sell orders and sell stop losses being triggered. Now the buyer positions will automatically be exited when their stop losses gets hit, while the sellers are still in their trade and their buy stop losses are still active above the support level. Now, once all the smart money orders are executed by the retail sell orders, which was accumulated below the support, they will push the price higher. And what will happen now? Now, all the buy stop orders which were set by the sellers will get triggered, and they will also be out from their trades. This will lead to the market moving higher strongly. This will in turn induce the FOMO traders to start buying and thereby pushing the markets even higher. This is a typical case of false breakout and liquidity grab in the market. And even now, a majority of retail traders are unaware of this smart money trap. The same action plan happens in the case of resistance levels also. Here also there are two players. There are sellers who look to take advantage of a reversal from the resistance level so as to initiate a short position at or below the resistance. They will set their stop losses somewhere above the resistance level. Then there are buyers who are looking to benefit from a breakout above the resistance so as to buy above the resistance. These guys will set their stop losses below the resistance in the event of a breakout. So there is buy side liquidity above the resistance and sell side liquidity below it. And as you might have guessed, the smart money will try to manipulate both these players. They will first push the price above the resistance so as to execute their sell orders at higher valuations by absorbing the buy orders or buy stop loss orders, thereby taking out the short sellers out of their trades. But the breakout buyers are still active in their trades and their stop loss orders are still live below the resistance level. Or, in other words, the sell side liquidity is still available below the resistance. And once all the large smart money positions are filled, they will push the prices lower, thereby absorbing the sell side liquidity and taking out the breakout buyers. This will cause the price to fall rapidly, which will encourage the FOMO participants to start selling and thereby causing the market to decline even lower. This is another typical case of false breakout associated with a liquidity grab. A similar approach is seen during consolidations, especially the rectangular ranges. When it comes to rectangle patterns, we have a bottom support level and a top resistance level. So, most often, the false breakout happens in the opposite direction of the market trend. For instance, if the market structure is bullish, then most probably we might see price absorbing the retail liquidity available below the bottom support level and then push higher to form a real breakout above the resistance level. On the contrary, if the market structure is bearish, then most probably we might see a false breakout above the top resistance level so as to absorb all the buy side liquidity, and then the price might move lower and form a real breakdown below the support level. Now, this analysis is not 100% accurate because we cannot predict the occurrence of a false breakout perfectly. Since there is liquidity available on both sides of support and resistance, it can lead to more than one fake outs. Or in some cases, there might not even be a fake out. Now, let's talk about the next category of internal liquidity, which is the trend line liquidity. Now, trend line liquidity is one of the most common types of smart money manipulations that you can encounter on charts, especially when there is a predominant trend involved. Technically, there are two types of trend lines: uptrend lines and downtrend lines. Another important thing to keep in mind is that for a line to be considered as a trend line, there should be at least two touches on it. And to confirm a valid trend line, there needs to be at least three touches on it. Now, this concept is easy to understand if we compare it to support and resistance. So, consider the uptrend line as a support level for prices and downtrend line as a resistance level for prices. Now, it is easier to visualize the events better. So, let's start with an uptrend line. As I have mentioned, an uptrend line acts as a support for prices. So we can expect two types of participants waiting to take a position. There are buyers looking to go long from the support trend line. Then there are those short sellers searching for a breakdown below the support trend line. Thus, there lies buy side liquidity above the uptrend line and sell side liquidity below the trend line. This means most often both retail buyers and sellers stand to lose their stop losses. The big institutions will first push the prices down to break below the uptrend line. This means all the sell stop orders of buyers and sell limit orders of short sellers will be triggered. The smart money will try to absorb all the retail liquidity to ensure that their large buy positions are executed at the lowest prices possible. Now, only the short sellers are active in their positions with their buy stop losses live above the trend line. Once all the smart money orders are filled, they will take the prices higher, revisiting the buyback orders placed above the support trend line. By doing so, the short sellers will also be taken out of their positions once their stop losses are triggered. This will in turn push the prices higher. So you can see how both retail sellers and buyers are equally affected by such a manipulation. A similar scenario persists when it comes to downtrend lines also. There will be buy side liquidity above the resistance trend line and sell side liquidity below it. The smart money will create a false breakout above the trend line, sweeping all the buy side liquidity in order to execute their sell positions at the best possible valuation. And once all their orders are filled, they will reverse the prices to move lower, which then takes out the sell side liquidity, and then combine it with the new FOMO sellers coming in, the market will fall even more. Finally, there are people who look to trade prominent chart patterns like flag patterns, which unfortunately is yet another internal structure formation that is prone to liquidity manipulations. You might know about flag patterns, how it forms, and how to trade them. If you don't, you can watch it in my chart patterns course video. Basically, there are two types of flags: bullish flags and bearish flags. Let's start with the bullish flags first. Flags are continuation patterns, meaning that the possibility of the existing trend to continue is fairly high. When a bullish flag consolidation is spotted, the retail traders will look for a bullish breakout above the top resistance line. Now, majority of this group includes buyers who are looking to take a breakout trade, and they will usually set their stop losses below the bottom support level. This is the usual practice. Now, the manipulation happening here is very exciting. First, the smart money will create a small reaction above the top resistance level of the flag. This minor reaction above the resistance will induce a lot of former retailers to take the bait. That is, they will think it is a breakout. And these traders would rush in and place their buy market orders and buy limit orders above the resistance in order to buy, and they will in turn set their stop losses below the bottom support level. But most probably, this reaction would be a false breakout to trap the retailers into taking a trade. Now, the price would move lower and break below the bottom support level, where lies a large clusters of sell side liquidity, and these institutions will ensure that all their buy orders are executed at the lowest prices possible. Sweeping the sell side liquidity means that all the buy stop losses are triggered and they are taken out of their trades. Now, what happens afterwards? Quite clearly, the market will bounce back higher and this time creating a real breakout instead of a minor reaction. And once a strong breakout with high volume appears, more traders would join in and the prices would rise even higher. A similar scenario takes place in case of a bear flag. But here, instead of buyers, the FOMO sellers would get trapped. A bear flag, as you may already know, is a bearish continuation pattern. So most of the retailers would look for a breakdown of prices below the bottom support line so as to take a short trade position while setting the stop losses above the top resistance line. So the smart money will create a sudden price reaction below the support line, which will induce a lot of retailers to enter into short trades. This activity causes a lot of buy stop orders getting accumulated above the resistance line. This is actually buy side liquidity. And the market will create a false breakout and it will move higher to grab this liquidity in order for the smart money to execute their sell orders at higher prices. Now, almost all the buy stop loss orders above the resistance level will be triggered, and those traders will be taken out of their positions. And once all the smart money orders are executed, the market will once again reverse and move lower. And this time, the market will form a real breakdown below the flag support, to which more short sellers would respond by selling aggressively, and the market will fall even lower. Now, there are other patterns and other situations in the market where internal liquidity is available for the taking within the major structure. Some of them are symmetrical triangles, price channels, supply and demand zones, etc. But the ones that I have discussed here are the most important types, and it is more than enough to get a fair understanding as to where to find internal liquidity and how to find smart money traps associated with them. Now let's move on to a few quick examples of such internal liquidity manipulations in the real market conditions. Take a look at this chart. You can see price making equal lows. So clearly there is sell side liquidity below this level. And what happens next? As you can see, the market moves down and absorbs these clusters of orders and then it reverses to go higher. Usually, when liquidity is absorbed, the price will move quite strongly. Moving on to example 2, what we have here is equal highs. And you know what that means. It means there is buy side liquidity available above this level. Now, the smart money are eager to manipulate or absorb these liquidity areas. And guess what happens? The price breaks into this liquidity area and sweeps out all the retailer orders above it. And then it moves down lower. This is a typical manipulation that you can find on charts on a regular basis. You can call it double tops or double bottoms also, but the logic remains the same. Now, example 3 is a support level within the major structure, and we have talked about how the manipulations takes place around a support level or a demand zone quite clearly. So there is buy side liquidity above it and sell side liquidity below it. And look what happens next. The market breaks below the support level, gets hold of the retailer stop losses, and then reverses and goes higher, taking out the buy side liquidity. This price manipulations affects both the players. Now, this is example number 4, which is a resistance level within the external structure. Here also, you can anticipate retailer orders stacking above and below the resistance. So there is buy side liquidity above the level and sell side liquidity below it. And as you can see, the price broke above the resistance level to sweep the buy side liquidity. And once it is done, the market reversed its direction. And in the process, it takes out the sell side liquidity and moved lower. Now look at this case. An internal uptrend line has formed within the major structure. From what we have learned, there are both types of orders available above and below this trend line. And look what happened here. The price broke below the trend line, thereby taking out the sell side liquidity, and then it did a sharp reversal and moved higher. Now, yet another example is of a downtrend line which formed within the major structure. Here, the price made a false move higher to grab the retailer liquidity and then reverse lower to continue in the major trend direction. The next example is one of a flag formation. This is a bullish flag formation, and as you can see, the price made a false breakout or reaction below the support level just to absorb the liquidity available in the form of stop losses. And then the price broke above the flag and moved higher. This is a similar example, but this is a bear flag formation. Here you can see the market took out the liquidity above the top resistance line, and then the price returned and broke below the lower support and continued to decline. In this manner, using this simple logic, you can spot innumerable liquidity manipulations in the charts. It could even be in the form of recognizable patterns that most retailers are keen to trade from. So go ahead and look for such manipulations and liquidity grabs in the charts, and also try to understand what happens next. You will clearly understand how the price movements are engineered in the markets once we have a discussion on a few more topics like order flow, order blocks, and inducements. We will continue this discussion in the upcoming episodes.
In this episode, we are going to learn another important topic in SMC, without the knowledge of which trading in the markets can be tricky as well as risky. It is none other than inducements. Some traders ignore the significance of this topic, while many others don't use it in the proper manner. We will try to fix this. So, in this video, we will understand what inducement is and what its significance is. Then we will learn different methods of identifying and spotting inducements in the market. Further, we will discuss about the different types of inducements, namely major and minor inducements. And finally, we will understand the difference between inducements and change of character. So watch the video till the end to gain complete understanding of the entire topics. So let's get started. Now there are different ways in which you can define an inducement. But I would like to think of inducements as an area or level where retail stop losses can be hunted, or simply think of it like a trap in the charts. The proper definition of inducement is that inducement is an area of deception where most traders believe it is the correct and right time to enter a trade, leading them to take wrong decisions at the wrong locations and in the wrong direction. So, the idea of an inducement level is to induce or persuade traders to buy or sell at the wrong location, thereby leading them to a trap. Now, inducement is a concept based on liquidity. For example, think of it like a level where retailers find an opportunity to take a trade. But for someone who follows smart money concepts, inducements give them an opportunity to take a counter trade against these retailers. Or in other words, inducements signal SMC traders that it is now feasible to take a trade. It is always advised that until and unless there is a proper inducement in the chart, one should not even think about entering into a trade position. This is because the chances of it being a trap otherwise is very high and you might end up in losses. So the reason why this is particularly important is because of the fact that inducement follows the nature of liquidity. So if you have noticed, liquidity follows an accumulation, manipulation, distribution cycle, also known as the power of three. Let me explain this. Accumulation represents a stage within the market cycle where prices tend to consolidate while engineering liquidity on either side. The manipulation phase follows the accumulation and is often marked by sudden and sharp price movements that catch retailers off guard. Manipulation occurs in the opposite direction of the real move, and it is aimed to stop out the retailers and induce the breakout traders. So understanding the intentions behind manipulation phase is very crucial. Smart money uses these moves to acquire more shares or assets at favorable prices. By triggering stop losses and inducing breakout players, they generate enough liquidity for their positions. They accumulate positions while retail traders are caught on the wrong side of the trade. Now comes the distribution phase. After accumulating at the best possible valuations and manipulating the market to their advantage, smart money begins to unload their positions to those eager retail traders who are late to the game. The distribution phase in SMC is quite a bit different from the distribution phase that we have learned in the price action course. Here, during distribution, the smart money slowly offloads their holdings